You finally get that raise or land your first well-paying job out of college and suddenly have disposable income. Society immediately hands you a script for what to do next. Lease a nicer car, upgrade your apartment, and order takeout without checking prices. There is a mathematical trap built into that routine. It's called lifestyle creep, and it is the invisible force that absorbs new wealth. This chart tracks a typical earner. As income goes up, lifestyle spending rises to match it exactly. You end up with zero net gap between what you make and what you keep. Earning more didn't make you wealthier. To build wealth, you must break that cycle. Redirect those new dollars away from depreciating lifestyle upgrades and into asymmetric assets. In this context, an asset is not limited to a stock portfolio. An asset is a high-quality tool, a proactive health investment, or a professional skill. To justify spending your newly earned money, a purchase needs to achieve one of two things. It must permanently lower your daily living costs, or it must permanently raise your income floor. Let's start with defensive spending. This is where you use a small amount of capital up front to stop massive recurring leaks in your daily budget. This table compares the cost of an $18 daily takeout habit against a $5 home-cooked meal over 5 years. Reaching that $5 price point requires a specific upfront input, roughly $150 for a solid knife and nonstick pan. Looking at the bottom of the table, that single purchase converts an expensive habit into over $2,300 saved every single year. The trade-off here is straightforward. You are sacrificing the convenience of delivery apps and committing a few nights a week to meal prep. That exact same defensive logic applies to your physical wear and tear. Spending $150 on durable, ergonomic footwear stops the cycle of buying and destroying $40 fast fashion shoes 4 times a year. These defensive tools are essential for stopping the bleeding, but mathematically, their absolute value is capped. You can only save as much as your total living expenses. Next, we have passive optimization. A basic 2% cashback credit card lets you earn a return on money you are already going to spend. The average American household spends about $77,000 a year. Routing that through a 2% card generates over $1,500 annually, right back into your pocket. This tree illustrates the behavioral trade-off required. Do you pay your balance in full every month? If no, a 24% interest rate violently wipes out any reward. The right move is a debit card. But if yes, disciplined spenders should capture that 2% spread. Chasing credit card points without baseline financial discipline is a trap. Risk management always has to precede optimization. Defensive spending caps your expenses. To really scale your wealth, you need to play offense and uncap your income. You can purchase professional leverage through widely recognized, inexpensive certifications in fields like data analytics, AI, or project management. The required input is highly accessible, anywhere from $0 to $500 in capital and a few months of dedicated evening study. This quadrant chart plots financial cost against potential income impact. A certification sits right in the low-cost, high-impact corner. For a worker earning $55,000, these credentials bridge the gap to $75,000 roles, permanently raising the floor for future negotiations. The trade-off is a heavy cognitive load. You sacrifice your evening and weekend leisure time to proactively learn. Compare that to the standard societal default of financing a brand new vehicle. A new $50,000 car lands entirely in the high-cost, negative impact quadrant. A reliable used car or a good kitchen pan caps your annual savings at a specific dollar amount. Investing in skills creates a compounding return. That initial salary bump becomes the new baseline for every percentage-based raise and job hop you make over the next 30 years. None of this matters if you failed to protect the biological machine that is actually generating the income. Purchases like a premium mattress and an ergonomic desk setup are direct investments in your future productivity and daily energy levels. The same logic applies to scheduling routine checkups, physical therapy, and mental health care before a crisis forces you to. This scorecard lays out the stark reality of the American healthcare system. A sub-$200 preventative checkup is measured against a towering $18,000 emergency room bill. It is psychologically painful to spend hard-earned money to prevent a negative scenario that hasn't even happened yet. But failing to proactively fund your physical and mental health today guarantees you will pay a much higher, forced reactive tax later. This roadmap summarizes the entire capital allocation plan. A raise is not for buying nicer things. It is capital to buy yourself out of future problems and buy yourself into higher earning tiers. If you struggle with debt, ignore credit card points entirely. Buy a reliable $20,000 used car, stick to your debit card, and focus on stopping your daily financial leaks. If your basic expenses are controlled, stop worrying about clipping coupons to save a few pennies. Deploy $500 into a professional certification to raise your income floor. If you're a high earner, deploy capital into your biological assets, like ergonomics and sleep, and protect your wealth by maxing out a Roth IRA. The friction with all disposable income comes down to this. Depreciating lifestyle upgrades are easy, while compounding leverage requires effort. True financial optimization requires recognizing when to use tools to build a defensive floor and when to proactively invest in an uncapped ceiling.